When you deposit money into your bank account, you might assume it's safely stored until you need it. However, banks operate differently. They keep only a small portion of your deposit and lend out the rest. For instance, if you deposit $1,000, the bank might hold just 10% as reserves, lending out $900. This $900 is then deposited elsewhere, and the cycle continues, multiplying the original deposit. This process creates digital money, not physical cash. When banks issue loans, they simply type numbers into a computer system, generating money that didn't exist before. This is the illusion of money. Fractional reserve banking allows banks to lend out more money than they actually possess. With a reserve requirement of 10%, banks can lend 90% of every deposit, effectively multiplying money in the system. Here's the catch. Banks charge interest on this newly created money. When you take out a loan, you're borrowing money that was created the moment you signed the agreement, not money the bank already had. Yet, you must repay it with interest. This is how banks generate significant profits, by creating money from nothing, lending it out, and earning interest on it, all while holding minimal reserves. Our economy thrives on debt due to this system. The more loans banks issue, the more money circulates. If all debts were repaid today, the money supply would shrink drastically. Banks encourage borrowing through credit cards, mortgages, and loans, as their profits depend on people owing them money. Consider a 30-year mortgage for $300,000 at a 5% interest rate. You won't just repay $300,000, you'll pay closer to $580,000. That extra $280,000 is profit for the bank. Banks offer easy credit because they know that as long as you owe them, they will keep earning interest. If banks can create money, who regulates them? Central banks, like the Federal Reserve in the US or the European Central Bank, set the rules and control interest rates, impacting money creation. Low interest rates encourage lending, increasing money supply, while high rates slow borrowing. This system benefits banks and the wealthy, while the average person remains in debt. Central banks also influence inflation. As more money is created, existing money loses value, causing prices to rise. This erodes savings purchasing power. The more money in circulation, the less your money can buy, affecting everyday financial stability. The system is designed so inflation erodes money's value. As banks create more money through lending, the money supply increases, leading to inflation. Over time, living costs rise, wages struggle to keep up, and borrowing becomes necessary to maintain living standards. Meanwhile, those controlling the system, banks and wealthy investors, benefit. They invest in assets like real estate and stocks that grow in value, while regular people see their savings shrink. For example, with 3% inflation and a 1% interest savings account, you're losing money annually. This is why investing wisely is crucial to stay ahead of inflation's impact. Understanding how banks create money is the first step to protecting yourself. Be smart with debt, only borrow what you need, and pay off high-interest loans quickly. Avoid unnecessary credit card debt, and be cautious with large loans like mortgages. Invest your money instead of just saving it in a bank. Whether in stocks, real estate, or a business, investing in assets that grow in value helps combat inflation. Educate yourself about the financial system to avoid common traps. Knowledge is power, and being aware of these banking secrets can help you make better financial decisions and achieve real financial freedom.